So this is one of our first presentations, and I always start in my hometown, New Britain, because that's where I'm from, New Britain, Connecticut. And we're at Teaser's Barbershop, 188 North Street, New Britain, Connecticut. And we're here with Connex Credit Union with Katrina to talk about the difference between renting and home ownership, the opportunity of home ownership opportunity she's offering at Connex that's not advertised anywhere else, and how she's partnering with INCarcerated Anonymous and Teaser's Barbershop, who happens to be also a client of Connex Credit Union, to do a presentation in a community that most people don't come and talk to about potentially being homeowners. Or if you're on SSI or SSDI, you could be a multi-family homeowner, have your own space, nobody kicks you out of. You can afford it because you can rent out the other apartment or the other 2 or 3 apartments because it's up to 4 units. And you could give back by helping someone who's just as impacted have safe, clean home, a rental home, because OIA is helping people who are just as impacted find clean, safe housing. So we'll all work together as a community to provide just as impacted families and individuals housing, clean, safe housing, and also build up our community wealth. Each one teach one, each one house one. Become a homeowner today, multi-family or otherwise. Okay, so I want to thank Katrina from Connex Credit Union for showing up today. She's about to educate us on renting versus home ownership, also what it looks like to be, how you can become a multi-family homeowner and help out your community by renting to your neighbors, and anyone who's a part of INCarcerated Anonymous. We'll get into that stuff later, but I give you my friend and colleague Katrina, and she does community development loans at Connex Credit Union. Katrina.
Thank you. So it's so great to be here. And those of you that can join us online, thank you. We really want to get into the nitty-gritty of how you can become a homeowner, and not just become a homeowner, but also to have stability in your homeownership. So being able to stay, stay in your home, and just first steps, because it's really hard, it's difficult to do it sometimes, which is why programs like this exist. So this is the Community Development Loan Guide. This is a home buyer education. This is March 2023. Again, my name is Katrina Goins. I am a Community Development Mortgage Loan Officer, and MLS number 970-943. You can start with the first one. Thank you. So know the difference. Hashtag thinking. Renting versus homeownership. I'm going to break down some of the stigmas associated with what is the big difference between staying as a renter and then actually becoming a homeowner. So people are constantly saying, I am paying either the same amount or more in rent as I would with a mortgage, and especially with this inflation, actually rents are starting to become more than what a mortgage payment would actually be. So this is true. That's a very true statement. But the question you want to ask yourself is, can you handle the costs associated with homeownership at this point in your life? You have to ask yourself, are you mentally, emotionally, and financially ready for homeownership? I'm not looking to deter anybody's dreams, but rather I would want you to wait until you do think that you are ready, instead of losing your property, which is something I hate for, just to see as someone in this field, and as someone, also that's just highly encouraging people to be homeowners. I want to also see that you can actually stay as a homeowner as well. So remember, you can't call your maintenance guy when something breaks in your house, or you can't call and ask someone to pay your water bill, your sewer bill, etc. etc. I highly encourage people to, prior to looking into becoming a homeowner, working with a HUD certified financial counselor or housing counselor, which are available at your local neighborhood housings. There's one actually right in Waterbury, I think that's the closest one. There's others in New Haven. You know, they actually specialize in that to help you if it's a credit problem or if it's just other things that you're experiencing. Work with a trained professional prior to you taking those steps. And then I want to just break down also home ownership. So what are the costs associated with home ownership? Other than your monthly mortgage payment, there is the water bill, there's a sewer bill, there's oil for homes that use an oil or have an oil tank, general house upkeep. And I just gave some examples. So, your roof is leaking and the water heater is broke. There goes to $6,000 for a partial roof and a new water heater. So just keeping those things in mind. Again, not trying to deter anybody, but also trying to be realistic in terms of what's going to happen when you become a homeowner. These things do come up. So you want to strategize your home purchase. You need to understand. Similar to when you're buying a car, you want to also go mortgage shopping. Not every mortgage program will work for you. The best way to do this is first by seeing how much you qualify for, and then you can get a free credit or a free pre-qualification that does not require them to run your credit report. You don't want to let them run it for the pre-qualification, but that is to see how much you will qualify for. So certain lenders, such as myself, Connex Credit Union, will allow you to get a free pre-qualification without running your credit report. You can also do it yourself. You don't feel comfortable talking to somebody because you don't want to get a whole bunch of phone calls and get all these advertisements. Completely understand that. Connex has a free pre-qualification calculator on our website, which is listed in this link here. Once INCarcerated, will have access to this slideshow, so you'll be able to click on this link if you're interested in getting the qualification ran on your own. You could just go on that website there. After you determine how much you qualify for, the next steps is to look at interest rates. I suggest browsing at least 3 different lenders so you can compare and contrast. Understand the best way to effectively compare lenders is not by solely asking the interest rate, but asking what the APR is. APR stands for annual percentage rate.
I have a question.
Yes.
How does the annual percentage rate affect your mortgage?
So the annual percent, I think I actually am going to cover that too.
Okay, well, let me go into the next slide.
No, actually, I'm sorry, it's not in this prior one. I had that in another one. I didn't want to make this one too long. But the annual percentage rate, it does affect your mortgage because it's the actual, what the actual rate is. It's not really, the interest rate to me is a marketing stunt. They say, oh, you have an interest rate of 5%, but the APR is actually 6.3. That's a big difference when you look at it in terms of what you're actually going to be paying. Mm-hmm. And then there's something called an amortization schedule, which will show you all the interest you're paying over the 360 months if you're doing a 30-year term, which most people do in the beginning. So that actually breaks down the full APR, which is the annual percentage rate. You want to know the APR more than you want to know the interest rate.
Okay, thank you.
You're welcome. And then you can go to the next slide. Should be, yep, that one, yep, okay. Thank you. So what is Connex doing about inflation and helping people with their American dream? So in addition to what Connex already has, which is, we do offer credit builder loans, we offer secure credit cards, we have free financial counseling through our advocacy program, and we have revised non-sufficient fund fees that went into effect in August of last year, 2022. So those are things that, you know, in general, some things that we're doing to help. But we introduced the community home loan products last year as well in August of 2022 when I came back on board. Those 2 programs consist of the conventional community development first-time homeowner mortgage. This includes down payment and closing cost assistance. It allows you to go over the assessed property value, which what that means is if the house is worth $250,000, will allow you to borrow maybe $275,000 instead, just so you can either have down payment assistance in that extra $25,000 or for you to do repairs, which is called rehab, in the home. That's unusual for a mortgage to do that. So you can borrow over the assessed property value to do necessary repair work to the home. There's no private mortgage insurance, aka PMI. What that is the extra cost, doesn't do anything for the actual borrower. It's all for the bank. It's extra money that the bank uses because of risk, because if you don't have 20% down, they want you to pay a little extra more so they feel comfortable giving you the mortgage. So we don't have that on this. There's no private mortgage insurance. Usually that is $100 to $200 every month for the first 5 years, usually, that you have that property. There's no points, so sometimes lenders will say, hey, if you pay an extra 1 or 2 points, which is 1 or 2% of the purchase price, we'll bring down your interest rate. No, the interest rate is already at the lowest that it can go legally, what we can do. You don't have to pay any points for that, so there's no extra fees on that either. The rates are below market. So right now, I think we're at 5.2. If you look out everywhere else, it's 6 and above interest rate. So you're saving a lot of money in that way too. The underwriting, which means that's the people that make the decision on your loan. I'm just the loan officer, but there's people over me called underwriters. That is flexible. I'm able to coincide with the underwriters to say, hey, they'll listen to me and my opinions on why I want to give someone a loan. They won't just up and deny someone without hearing me out first. A lot of underwriters will just be like, no, it's our decision, it's our say. They actually allow me, they trust my decisions and my opinions about my customers. If I feel strongly about someone, they actually will take the time to listen to me. I have to give them a very good detail. I feel like a lawyer sometimes, but I'll give them a very good reasoning of why I want that person to get the loan, and they will hear me out. So don't get me wrong, can they still deny people? Yes, but there's more of it's an 80-20 with that. There's more of a chance of them listening to me and saying, okay, we'll work with them, opposed to the other 20% where there's just like, no, Katrina, that's not a good person. So there's flexible underwriting in these loans. The underwriting is similar to FHA, which is the Federal Housing Administration. Everybody knows that, oh, FHA is the best way to go. Not always. This is a conventional loan. It's a conventional loan, but it has similar FHA underwriting, so it's very good in that way. In a more simplistic concept, these loans are for low to moderate income people. People with higher debt to income ratios, that means you got some debt, not a lot of money saved or no money saved at all, but a desire to be a homeowner. Next slide, please. Further information on the community development loan product. So prospective borrowers' income cannot exceed 120% area median family income based on HUD's median income limits. What the heck is that? Well, there's an income limit that I use, and for example, let's say it's a household size of 4, it's 2 adults and 2 children. They're looking to buy within the Harford County. That means the whole household income can't exceed $135,240. That way, you know, I know they can do the program. If your income is over that, unfortunately, that actually goes over our allowable income limit, so you wouldn't be able to go with our program. But the income limit is set still pretty fairly in my opinion, because a lot of other community programs, they want you to be really poor in order for you to work with their programs. This one, I allow people to still make some money, because you could still be struggling making 6 figures, but you could still go with a program that's going to help you. So we do have to have an income limit. There's no way of getting around that. But again, it's 120% of the area median family income. So that's just an example. That's what the income limit is for the Harford County on a household size of 4, $135,240. Household gross income can't exceed over that amount. The loan minimums for the community loan is $50,000, so you can't go below that amount. You have to borrow at least $50,000. The maximum for the program is $450,000. So your house, you can't borrow more than that. If you do, you probably should be going with a regular program. So the rates are lower than most competing community lenders and lenders in general, and they're actually lower than CHAPA, which is the Connecticut Housing Finance Authority. Most other lower rates even than VA, USDA, and I checked because I'm very competitive. So we're pretty much low, but you can still compare and contrast. I want you to do that, matter of fact. Payment terms. So you have to borrow a 30-year mortgage. You can, of course, pay it off quicker than that. There's no prepayment penalties. If you want to pay more to the principal, I suggest you do that. You do have to have a minimum credit score of 620. It does have to be owner occupied. That means you do have to live in the property. However, we will allow you to buy a multi-family just as long as you live in one of the units. You could buy a property that is up to 4 units. So if you want to become a landlord, please use our program to do so. You only need to put 2% down if you're buying a multi-family property. That's unheard of, you know, for any other properties. Even FHA, it's 3.5%. It's 2% for our program, and then you don't even look at another conventional program. It's 20% down, and you know that's a lot of money if you look at what the house prices are today. So we're encouraging people to go ahead and get the residual income, become a landlord your first time buying your home. We encourage it, and we want to help you do that by having this product out for you. If someone's not approved for the loan, I work with the prospective borrower. Please know I hate the word denial. I don't use it actually in any of my conversations with anybody. Even if you aren't able to get the loan, you won't hear me say that you were denied. I just tell people it's not your time. Let's come back and revisit this, because your time will come. If we got to fix in this area or this area here, let's work together. I do that. I'm also a certified financial counselor. So that's really important to me that people don't get their dreams deterred because they can't get the loan at this time. Again, it's flexible underwriting similar to FHA, but without all the FHA rules. You do not have to worry about subsiding to the government. There's none of that on this loan. First-time homebuyers are required to take a first-time homebuyer education class. But once you do that, it has to be with a HUD certified agency too. So you can go through CHAFA, a neighborhood housing association, one of those, you know, nonprofits. But once you take the homebuyer education class and we see your certificate, I will give you a $1,000 closing credit. We can use non-traditional credit verification. So somebody could be coming to me, they don't have any credit. Fine, I want to see that you paid your insurance on time. I want to see you paid your rent on time. Something like that, we could still get you the loan. So even if that's the case, if that's your situation, please don't let that deter you either. We work with people with no credit. You must be a Connex member to submit an application. Just a savings account, that's all we ask. Just $25 to open it. Yes, it is required. Currently, our down payment assistance is repayable, which means the money we give you for the down payment and closing costs, it's something you have to pay back. It's included inside the loan. But I am working on other options for people to not have to pay any of the down payment and closing costs. And currently, we actually, in this moment, in March of 2023, we do have a program. It will not last long. It'll be for about a couple months. We do have a program through the Federal Home Loan Bank of Boston that goes up to $29,000 of money you don't have to pay back. If you are income eligible, you have to meet that 120% area median income. Like I said, if you can get a sales agreement, get an offer accepted on the property, I will personally put your application in. If you go through Connex Credit Union, I will try to get you that money. Again, that's on a first come, first served basis. That program won't last long. Can you go to the next slide?
Quick question. Is this only for people that have been incarcerated or for general?
This is in general.
Perfect.
Yeah, this is in general. This is for everybody. Properties do have to be in the New Haven, Hartford, Middlesex, or Fairfield County, though. You can only purchase in there because that's where Connex Credit Union does business. And what about FHA, which is the Federal Housing Administration? How is this different? So I broke down some differences between our program, which is a conventional program, community mortgage, and FHA. So FHA has flexible underwriting. That's obvious. They've been around for a long time. They allow people to have a 580 credit score, can still get you a mortgage. Lower interest rates on FHA, yes, and they don't have any points. There is strict government rules and longer closing times. That means that it takes longer to close on these FHA loans. All FHA mortgages have a requirement to pay mortgage insurance premium, aka MIP, during the life of the loan unless the borrower refinances or supplies a hefty down payment. That's the only way you can avoid that. MIP is like PMI, which is private mortgage insurance. It's going to be an extra $100 to $200 in your monthly payments for the first 5 years, usually. There is a requirement to pay 3.5% down payment on an FHA. The closing costs on FHA loan usually does exceed the closing costs on a conventional loan. They are higher because this is a government loan. You know, there's risk involved, so they make you pay for that. Less buying power than conventional. Some FHA loans will not allow you to buy certain condos. If that condo is not, if it's not FHA approved, you will not buy it with an FHA loan. So that's out. Now, the conventional community mortgage, ours is flexible underwriting. Ours have lower interest rates. Ours has less rules and a quicker turnaround time to close. If somebody says, Katrina, I need to close in a month and a half, I will meet that. I will try my best to meet that. There's no, you know, oh, well, we can't do that because we're working with the government. No, I'll try to meet. Wherever you need me to do, I'll try to do it. No private mortgage insurance, so no MIP, no extra money in your down payment, no points. The closing costs, low. They're low. Really low, because we try to make everything more affordable for people that are going through this program. We allow you to borrow over the assessed property value. We allow you to bundle back in the down payment and the closing costs, and we allow you to bundle back in rehab. It can't be like regular, you know, like, oh, I want to get a new kitchen. It can't be like cosmetic, but you can do like things that you need to get done. If you need a new water heater, if you need new floors, we'll allow you to do non-cosmetic repairs in the property, and you can bundle that in your first mortgage. More buying power since it's a conventional mortgage. I had a borrower. There was 5 other offers on a property. All other offers that was submitted for that one property was FHA loans. She was a conventional. Even though somebody was going to offer more money down, they took my client's offer because she had a conventional. They didn't want to deal with an FHA loan. So I'm just letting you know, it's more buying power when you go with a conventional. And when a seller sees that in this very competitive market, it's actually a really good thing. Next example. Next slide. Okay, so this is just an example. I did a real life scenario type of example. Typical applicant for my community development mortgage. So I said credit UNA. This is a person. Is a single mom, and she works at Amazon full time. She's making $18 an hour. This averages out to $37,440 gross annually. She also does Instacart, bringing in an additional $800 per month. She attends Gateway Community College part-time to get her associate's degree in business law, which she hopes to become a paralegal. She's looking to get a 2-bedroom condo for her and her son, and she's applying by herself. She originally went to get an FHA lender, but the FHA loan consistently gave her issues with the condos she was looking at. Credit UNA is taking money from her retirement for her down payment and closing costs, and she has a 625 median credit score. Credit UNA heard about this community development loan program at Connex through word of mouth. Katrina was able to pre-approve her for around the same amount as her former FHA lender at $190,000. Katrina was also found her some forgivable down payment and closing cost assistance money, because that's something I often do, and was able to bundle back in some of the down payment money she needed since the program is conventional. Credit did not have to worry about any problems with getting her condo approved under FHA guidelines. Her payment was lower because Connex does not have private mortgage insurance on the community loan product. And also the down payment assistance that Katrina found her brought her monthly payment down, making her payment more affordable. This is an example of what the community conventional mortgage looks like with an experienced community mortgage loan officer.
Say that, Katrina.
Bridging the wealth gap in Connecticut with asset building / establishing equity. One of the best ways to build wealth and begin asset building is to acquire real estate. Connecticut does not have any towns or cities, according to the CDFI fund, considered under-resourced or undeserved due to significant wealth gaps of those residing in the same town in specific areas with different household incomes. What do I mean by that? Connecticut does not, what they say, statistics say, we are a wealthy state. We don't got no problems financially. But what they're not looking at is people that have higher incomes are residing in the same places that people have very low incomes, which it makes it look, when you collect that data together, it makes it look like the town in itself is doing well. But what they don't know is there is census tracts of where some of those individuals live that have the higher incomes, and it's a cutoff between same town where those other lower income people live. So they're collecting data, it's incorrect, there's a gap there. So what Connecticut looks like to everybody else, like even when I traveled out to Las Vegas one time, I told somebody I was from Connecticut, and they were like, oh, so you got money. I was like, no, I don't. You know, like this is the reality though, because they're looking at these stats and they're incorrect. There's a big wealth gap in the state of Connecticut. So just so you know, Connex is a community development financial institution. So we're looking at this holistically. How can we bridge this wealth gap? So we're looking for specific people for our community home loan program. For example, those paying high rents or tired of paying rent overall and want to be a homeowner but not a lot of money saved. Those with no credit but have a good payment history on other things such as their rent, utility bills, insurance payment. Those that are looking to buy a multi-family home and need to put less money down. You know, we told you we're only making you put down 2%, and 1% can be bundled back in the mortgage. Those that like the property price, but the house needs a lot of work, and they want to bundle that house, you know, that house cost to fix it up and include it in their mortgage, because realistically, it's a lot of money if you just got a house and you want to fix some things up. To do another loan on top of that, you're going to start going into being something called house poor. We don't want that. So last but not least is just any questions, which you can always, what you can do is you could type them in, or you can, you know, let Larice know, myself know. My contact information is right there with my email address as well as my phone number. I hope you gathered something from this and retained a little bit, if not all of it, because I really want to see people succeed. So again, my name is Katrina Goins. I'm your Community Development Mortgage Loan Officer, and I'm happy to do what I'm doing.
Thank you.
That's a great presentation.
Any questions? So what about, like, I'm on Social Security disability, right? And I know with my income, it's set, right? I know I couldn't get like maybe a condo loan, but what if could I go through you to get like a 2-family or 3-family and get qualified because I'm using the other
The rental income.
The rental income is part of my income too?
Yes, so we take rental income for those telling me they're going to purchase a multifamily. What every lender usually does, including us, is take 75% of that rental amount that people are telling us, and we can use that to qualify you for higher. Even, you know, it doesn't matter if you're on Social Security disability or anything like that, because we can't actually discriminate your way your income is coming in. So that doesn't really matter. Just want to do what we do is we check if something sounds like not right. You're like, oh, I'm going to collect $3,000 off this one tenant. We will be looking into that. It's called a rental analysis. So we will check to make sure your rent is fair. But if everything checks out, if other landlords in the area are getting about the same amount of rent, that's fine. We will take that in and we will get you approved.
Thank you for breaking that down. Can you talk about the case where the woman didn't have any income and you got her a mortgage?
That was difficult, but yes, this is real life, and of course we're not going to use names, but I did have a client that is not having she doesn't have any income coming in. And she did have to get a co-signer on her loan, which was her father, but she is getting a multi-family property. She's going to live in one unit. She's going to rent out the other 2 units. The way I was able to pre-approve her is because she's going to get rental income from the other 2 units. Is it risky? Yes, but this community loan is a riskier loan portfolio. So we were able to pre-approve her because it checks out what she's saying that she's telling me what she's going to get in those rent amounts she's going to charge her tenant. It checks out in that area that she can get that amount in rent. So we were able to pre-approve her based off of that.
Depending on your credit score, if it's lower or higher, how does that benefit the person in this program?
So 620 is our minimum. If you can meet the 620 minimum, you're looked at the same way of an 800 credit score person. It doesn't matter for this program.
And what if it's like lower? Like what if I got 530, but you know, do you have anything to help out with?
Yep, I have a client right now. He had a 400 when he first met me. We've been working to get his credit score up. It's went up 150 points since then. We've been working to get his credit up with different ways of how he can build it. Because I'm a certified financial counselor, I just broke down his full credit report. We're starting it. He's still not there yet, but we're getting there. So
revisit it.
Yeah.
We're doing monthly visits to see what we can do, and I'm actually helping him with some collections type stuff. I was like, there's certain languages and words you need to use with your collections agency to make sure they get it off your score, your report. So we're still working on it.
She helping them
revisit him
yes.
in a little bit.
Yeah, she's helping them telling them ways to get his credit up.
A lot of other people would have looked at a 400 and were like, I don't know where you going with that. You can't even get an FHA with that, you know. So, but no, I just look at it. And I don't judge people. We don't know what what he went through. So yeah, so that's it for that.
Any more questions?
No, that was a beautiful presentation.
Thank
you so much.
Thank you.
By the time you're done, it's gonna be.
I need your card. 'Cause I'm
So we have people are leaving because they came and got what they needed, but also I'm going to and it's great. Go ahead, leave out the door.
I'm trying.
Oh,
No, I got you.
We got emergency buzzers. We safety in the hood. You gotta be safety in the hood. It's safety in the hood. So I don't mind about the commotion. This is being recorded so that people can get the information. I edit out a little stuff, but I'll never edit out because it's real. And what I want to tell you about is what Once Incarcerated Anonymous is doing. And what we do is we're having a program called Once Incarcerated Anonymous Housing Ambassador Program. And it includes transformative coaching with Path to Purpose. Winning Ways does financial literacy. And we do the program coordinating and the program case management. And we make sure you are prepped either to meet with Katrina or you're prepped to become a successful renter, because sometimes you got to be a successful renter before you become a successful homeowner. And we help you with all those things. And we also working with many on-the-job training individuals who hire people with criminal background.